today we're going to learn the concept of how to make an extra income from the stock market, and that too from your mutual fund investments. So most of you today are putting your money into an SIP or into a mutual fund where you're hoping that at your retirement age, when you're turning 60 or 50, whenever you want to retire, you can withdraw that money and live your life very happily. But think about it, when you actually get to that point, do you need that entire corpus with you all at one place, or do you need it in fixed monthly installments? So just like how you put in the money monthly, you can withdraw the money monthly as well, and this is known as systematic withdrawal plan, and that is the exact concept which we are going to learn today. So hi everyone, and welcome to another video by marketfeed, where we're going to learn about everything you need to know about SWP. So currently, let's assume that you're a 27-year-old and you're investing into the market through the SIP route every single month, and that you're increasing this investments every year. So let's get to the step up SIP calculator to see how much this investment journey, how it will play out for you. So let's assume that you're earning a decent salary now. Let's assume that you're putting in 25,000 rupees every single month into a mutual fund and increasing that amount every single year by 10%, and you're expecting a return of a conservative return of, let's say, 12%. And if you keep doing this for 10 years, you'll get to a corpus of 84 lakh rupees. If you do this for 15 years, you'll get to a corpus of 2.17 crores. And if you have to, or if you do keep on going at the same pace for 20 years, remember, starting with an SIP amount of 25,000 but increasing that amount 10% every single year, and you're expecting a 12% return as well. If you keep doing this for 20 years, you'll reach a corpus of 5 crore rupees. So let's say you're a 27-year-old now. By the age of 47 to 50, you'll have this big corpus with you, and how do you plan to live on the rest of your life? That is a question. So here is where the beauty of systematic withdrawal plan comes in. So you had a plan, you invested all that money for the long term, and right now you have a corpus. And when you're looking to retire, you can go to this SWP calculator just to get an idea, right? You have this 5 crore investment with you. You are wanting to withdraw, let's say, 1.5 lakh rupees, because if you have that much of a corpus, you would want to live a lavish lifestyle. Am I right? And when you're doing that, let's assume you're getting a ROI of 9%. If you're keeping on doing that for 20 years, what would happen? Let's see. So every single month you're withdrawing 1.5 lakh rupees. You're doing this for 20 years. You're keeping on withdrawing. You're not increasing that amount in this calculation, by the way. And at the end of 20 years, your money would have actually compounded and it would have reached 18 crore rupees. So do you understand what is happening here? So basically you have an underlying corpus of 5 crore rupees here, and based on the 4% rule, which says that you can withdraw up to 4% of this corpus every single year, you're withdrawing this 1.5 lakh rupees, right? It's not the exact amount. It will come out to 3.6%. You can increase this according to your calculation. It will come down to 3.6% when you're doing this 1.5 lakh rupees. For 12 months, it will come down to nearly 3.6% of your capital deployed. And if you keep on doing that, your underlying is keeping on increasing, and you are ending up with a lot of cash in your hands. And this underlying corpus growing and the monthly withdrawal together will ensure that you keep on living a happy, healthy life till the end of your times, right? The underlying is growing and you're getting a monthly income as well. Now, this might seem a bit tricky for a lot of you, because you're watching this video to understand that how to plan your life right now. Maybe you're reaching till retirement at this current age only, and you're wanting to get into that extra income in your life. So what do you have to do here? You can come here, select whatever value that you feel is right according to your lifestyle currently, your monthly withdrawal amount, and you'll see that how long you can last, right? So let's say you want to follow the same calculator but with a more realistic amount. So let's say you have 50 lakh corpus right now, and you want to maintain your lifestyle with an additional monthly income of 50,000 rupees after your retirement. And here, just expecting a 9% return over a 13 to 14 year period, you'll end up running out of your money. So let's say you're 50 years old by the time you retire. By the age of 64, your money will start running out, and this will help you plan your investments and your journey accordingly. So now that you've understood the concept of systematic withdrawal plans, let's get into the proper structure of the video, which is how to do it, when to do it, and what percentage interest or what percentage growth you can expect in the underlying. So now that you've understood the general concept concept, let's get into how it works. So just like how you're buying small units and growing up your SIP every single month, similarly in a way that, let's say you've at the end of your investing journey, you have 10,000 units in a specific mutual fund that you own. And from that point, you have the option of stopping the SIP and treating that same SIP or that lump sum investment that you have after a couple of years and turning that into an SWP mutual fund. So basically, you're redeeming certain number of units every single month, just like you were purchasing in an SIP. So every month, if you were buying 50, 40, 30 every single month, just like that, you'll go ahead and start selling small parts of that mutual fund unit. And the amount you put in here is just nothing but an indication of the current market value that unit or that mutual fund will have. So sometimes your 50,000 rupees withdrawal every single month might cost you 100 units. Sometimes if the market is low, that same 50,000 rupees withdrawal might cost you 120 units. But overall, in the longer term, you can still expect a constant rate of growth in the underlying, because this highs and lows of the market, they will even out. You can withdraw it in any frequency that you like, but usually people prefer the monthly withdrawal option because that acts like a salary. After they retire, that amount which is coming in acts like a salary to them. So now that the how to do it part is done, let's set the right expectations before getting into a systematic withdrawal plan or starting to get a monthly income from your mutual fund investment. So the first point is that obviously you have to put in a lot of money into the market so that the market can work its magic of compounding and return back that extra money to you. There is no game in the stock market without putting any money in. The next thing that you have to watch out for, I did not give a 10% or even a 12% growth rate when I went into the SWP calculator. Why did that happen? So once you start withdrawing your profits, you would want to shield yourself from the volatility of the market, and then you will start to focus less on equity heavy mutual funds and you will start to focus on hybrid or even pure debt fund. And when that happens, obviously your return percentage will decrease. And this is one important point a lot of investors who are looking to do SIPs do not remember. You should not look for an aggressive mutual fund to go ahead and do your SWPs. The third thing that you have to do is you have to take an inflation calculator. I'll put it down in the description down below, and you have to assume how much will be your monthly lifestyle be when you're at that age. How much monthly would you like to withdraw? And based on that, you have to start parking how much money ever is needed for your retirement. For some people, it might just be 50 lakhs. For some people, as I said earlier, it might be 5 crores and still you might not be satisfied. Here, there might be a lot of personal preference, but the thumb rule says that 4% of your underlying or whatever money that you've invested, that should be your yearly withdrawal amount. It should not be more than 4%. And when you're doing or following that 4% rule, you'll have the option of withdrawing extra money every single year as well. So when you reach the age of 50, your monthly, the expense inflation would have increased, a lifestyle inflation would happen to you. That means you would want to drive more luxury cars, you would want to live in a better house, and every single year you'll still have to account for more money. So the 4% thumb rule will save you from all of that. The third thing that a lot of people forget about is the taxation on this mutual funds. So yes, these are equity or hybrid mutual funds and they will involve taxation as well. So assuming that most of you will be withdrawing these mutual fund investments after a period of 1 year from which you have invested, it will be considered as long-term capital gains, and after the withdrawal comes in, you will have to pay that extra 10% from your profits to the government. There is no tax deduction at source involved, and you'll have to do that manual work. Either you'll have to do it yourself or you'll have to get a CA for that, and you'll have to properly file your taxes. And yes, obviously for all of this to work, you need to have a proper long-term mindset and you need to start planning your finances today. Yes, you need to start following marketfeed, get subscribed, and watch out for more such financial videos. And if you keep on doing that, I'm sure you, by the age of whenever your retirement is, this would only be one source of your income. You would have built, or you should ideally look to build multiple sources of income even at the age of retirement, and this SWP will act as just one of them. So when thinking about systematic withdrawal plans, you'll see a lot of noise in the market. Even in the current IPL season, there are a lot of ads running. Three things that you have to remember: one is taxation, second is returns will be lower when you're moving into a hybrid or a debt fund, and the third is a proper long-term investor mindset. So if you have liked the video, make sure you hit the like button, get subscribed, and I'll see you in another video. This is Ajay Ajith signing off. Bye bye.